Hello everyone and welcome back to the channel. My name is Brent, and in today's video we're going to be taking a look at the M1 Finance dividend portfolio. We're going to be taking a look at the week for the 29th of August to the 2nd of September 2022. We have only 3 months remaining here in the year 2022 where anything can happen right now. The market this year has been pretty unforgiving, right? There has been plenty of weeks of red and red, with some green scattered in between. We almost broke above and kept above the 200-day moving average, but it does seem that as of about a week or two ago, this may be our last green week for some time, right? It's as we go towards the end of the year, everyone gets more involved and takes a step back away as kids get back into school. Trips are less frequent and less free time. So we may have a little bit of a cool down period in the market as we kind of get into the holiday season, at the end of the year. Anyways, we're going to go ahead and hit 4 areas today. Number 1, we're going to go over the M1 Finance portfolio overall performance so far as of inception back in 2018. So this portfolio is over 4 years old now, started with $0 and grew it up to where we're at today, the Roth IRA. Number 2, we're going to be taking a look at the weekly performance in comparison to the main index. So we're going to take a look at our weekly performance and then look at the S&P, Dow Jones, the NASDAQ, and see how we did in comparison to them. And then number 3, we're going to go ahead and cover the activity, what companies rolled in dividends, which ones, how much are we currently holding in cash to invest. And then number 4, we're going to be taking a look at the current dividend portfolio income. Now, this portfolio has taken 4 years to get to this point, so it's not where we just kind of did a lump sum dump and then started kicking some dividends. No, this portfolio started at $0 and has had the maximum amount contributed to a Roth IRA that it can have per year, getting it to this point over a 4-year period. So we're going to go ahead and take a look at where this portfolio sits as far as total dividend payout and also total dividends for the 1 year going forward. Okay, so with that said, if you guys are brand new, definitely go down below, subscribe, follow along, and let's go ahead and get into the video. So let's go jump over into our portfolio, starting at the overall performance. Now, we can see that the return has came down very sharply over the last month. We can see a huge decline here where at a point we were up pretty nicely. We had hit all-time highs of $45,286.72 within the portfolio. That put the portfolio at an all-time high right there. It didn't reach total return all-time high. I think our highest was around 77.77, but it did hit the 60% total return overall. We did fall down. This is money weighted, so I don't know how to. There's no other option to kind of measure it in total percent. Because the way that this is money weighted, it kind of also calculates how much money you have invested and how much those positions have gained in not only market gains, but also in those earned dividends. So right now our earned dividends have now broken over $3,500. We're now reaching nearly $3,700 of earned dividends by the very end of 2022. We should technically have earned over $4,000 of dividends within this portfolio. And that's going to continue to grow and grow and grow into the indefinite future, where on a yearly basis, not too far away, we're going to have half of our yearly contribution that we can make to our Roth IRA coming or being created just within the account, which doesn't go against our contribution limit. So it'll be essentially like $7,000, $8,000, $9,000 of investable capital being able to be generated or contributed through into the Roth IRA. So very nice there. Now taking a look at our best performers, right? Our top 3 winners are Apple. This is not going to be one that's going to be easy to beat. That one's just been doing crazy lately. Main Street Capital, this has pulled back along with many others. These have been in the triple digits, but at one point Main Street Capital was in the 120s, 130s. Avi and Pfizer were also in second and third place for quite a while, but they kind of flip-flopped. WP Carey has been in second and third place as well, along with Lockheed Martin. It had pulled pretty far forward, and then it has been pulling back, along with many other companies out there. Now, heading down to our worst positions here, IIPR has fallen off a cliff, and it can't get up. It just kind of continues rolling down the hill, getting beat up along the way, and it is now down 50.14% within the portfolio. This is just, it's within the MJ industry, they do REITs, and they kind of rent out these facilities that they grow in, and that area hasn't been doing well as far as as far as the businesses themselves go and the rent associated with that. So there's lots of issues within that company at the moment. Stanley Black & Decker, no one's going out there and trying to buy extra power tools and all that equipment right now, as everyone's back into working from the office and not working from home, and saying that they're working while working on house projects. And then Clorox, big spike down after the end of the need for staying inside, keeping things clean. Everybody should continue to do that, but everybody just kind of bought products up front and front loaded it, so they have been taking a hit there. Digital Realty Trust down 33.29%. I think this was a lot earnings based. At one point they were positive by 12-15%, took a big turn the other way, 12 down. They were down 12%, and they have continued to make lower lows, which we'll take a look at here very shortly. So those are our 4 worst performers. Starbucks has pulled down slightly as well. Starbucks, JP Morgan, they had for a point broken. I think they did go into the double digits there for a short minute, but they have kind of been wandering around in the still positive, but just kind of in that barely trend line. So that is number 1, the overperformance with our portfolio. So far, we haven't gone to the negative. I don't think we will go into the negative. Our portfolio would have to take a pretty big hit to go into the negative. But if we go into the 39,000 range, we'll still be positive, but we'd have taken a pretty good hit there at that time. So jumping into number 2 now, what is the weekly performance? Now, this got hit pretty hard this week, down 3.04%. We can see market gains of negative 1350 right there. Now, a lot of this comes from Hormel Foods, down 9.18%. I don't think this is earnings based. I think this is just, a lot of money distribution, kind of slush-sloshing, trying to find opportunity in consumer defensive companies, and maybe people are taking out of consumer defensive and moving it into more risk on. So this one just got hit down 9.18% on the week. IIPR, this one's kind of in that one bleeding off, the worst position in the portfolio at the moment, down 6.32. Digital Realty Trust down 5.58. Apple down a whopping 4.77% there on a weekly basis. That's a pretty big hit for Apple. Nearly 5% to the decline for Apple on a weekly basis. So that's a pretty good hard hit there. So that is our worst performers. Our best performers were, nothing green this week. Absolutely everything in the portfolio was red this week. There was no safety areas that were green at all. Now, ours is down 3.04. When we look at the S&P 500, that was down for the week 2.64%. So, Monday, Tuesday, Wednesday, we're negative. Thursday, they try to have a little bit of bounce, right? We hit that 200-day moving average on Thursday. Thursday, I was watching. Are we going to bounce off that 200-day moving average, or are we going to break below and go into weakness? So that was a big day right here. Friday started off really strong. Friday, I thought, we're going to bounce off that 200-day moving average. We're going to start moving back forward. I actually did set some deposits to begin depositing cash to kind of, if we do bounce and kind of keep steady, I would buy a little bit more of the SPY. But then we lost that momentum. Everything started collapsing, and it just kind of trended even lower and actually broke and closed below 200-day moving average on the SPY there. Dow Jones, kind of same movement here, down 2.43 on the week. NASDAQ composite down 3.22, so a little bit harder hit versus the S&P and Dow Jones. And the Russell took the biggest hard hit, down 3.89% in the week. So S&P 500 and Dow Jones, generally our portfolio is pretty safe in comparison to those, but we do have these positions such as IIPR, Hormel Foods. IIPR has been one in our portfolio that has been beating our portfolio up. Digital Realty Trust as well. We'll take a look at DLR. I don't know if this is on my sheet here that I want to share with you guys, but as far as companies that are coming up on ex-dividend, I did want to show a couple that were coming up in September, October timeframe, and to kind of see where they're evaluating at this time. So that is the weekly performance. We actually underperformed the S&P, Dow Jones, and we came out a little bit better off than the NASDAQ and the Russell 2000. But overall, we do have a couple sore spots within the portfolio that I don't believe are going to be kind of recovering anytime shortly. So overall, S&P 500, there wasn't really safe sector out there, right? Every sector. This is the S&P 500 on a weekly basis here. Take a look at technology, communication services, consumer defensive, energy, industrials, financials, healthcare. All of it was green. So there wasn't any one sector that was safe. You know, generally there's a sector down here in healthcare that, you know, you'll see healthcare be semi-green. You could see energy being a little bit green. No, every sector out there was green. So it doesn't really matter. This is, if you just started investing and your portfolio is red, that's completely normal because just the market was in that mentality where, hey, we trended lower. We broke a 200-day moving average in the market. Everything kind of started selling off at the same time. So that's the S&P 500 and its sectors right there. Now, one of the areas I kind of want to showcase was number 3, right? The activity. The activity right now as far as where we're at. Now, last week we had the 29th, which is, well, actually we didn't have anything coming in. 29th of August to the 2nd of September, we did have one dividend right there, Siggy, $7.15. And then we really haven't had anything really prior in that week. From the 29th on, nothing paid out besides Siggy. So last week, our activity for the week was we had dividends from Siggy, and we did not make any purchases. So we have not been buying any companies right now. You can see here we have $600 in buying power. So this is from dividends that we've collected over the last few weeks, as well as the deposits. We make deposits of $127.66 on a weekly basis. And this is so that we can continue to dollar cost into the market. But with the market being at where it was, I decided, hey, you know, we're going to be trending. We're on a downtrend right now, and we can actually showcase that right here. Let me go ahead and pull the S&P 500 over the last 6 months, and we'll look at the price in the 200-day, 50-day moving averages. Let me go ahead and uncheck that, recheck that. Sometimes it just kind of slowly loads the chart here. There we go. Okay, so this is what I've been kind of watching here. We did have a really nice run up from these lows. You know, we had, I think S&P was at 370s, 380s, and we had a very nice run up. We had no problem breaking through that 200-day moving average right here, just no problem. You can see we had these little periods where we had that bottom, then we had a higher bottom, then a little double bottom here very closely, but a higher one. So then we broke through that 200-day moving average. We continue to use that momentum to hit all the way up to here. That the 50-day moving average is the one we kind of just broke through. But the 200-day moving average was that resistance point right here. We closed at $429 at the time when I was watching this. This right here was at $431 for the 200-day moving average, and we closed at $429. We didn't want to break it. Even intraday, it didn't break it. It just kind of bounced off of it and just kind of came back and just kind of set right there. There was no news to really push it over the 200-day moving average. But then, hey, we just started downtrending. We lost the momentum very, very quickly, much faster right here. You can see it took us a couple weeks to get to this point. And then within, I think, a week or two, it just got to this point. I think this is 1 week or 2 week momentum right here. But we clearly broke right through the 50-day moving average. There was no bounce, none of that. And we closed at 492.24. So here, we're retesting this point right here. And there's not a lot of support, right? If Monday opens up and we open up weak, or there's some news that comes out and that's all weak, we could fall down back to the 380s, back into 370s. Really, there's no sort of support at all until we hit about 380, 370-ish. So depending on how the market goes on Monday and this week, we may have the S&P and the market just kind of trending lower overall. So that is the activity. And what else did I want to showcase? Number 4, the dividends. So we're going to go ahead and cover number 4, the dividends in the portfolio. So our annual income this year, we did break, I think we had broken, not too long ago, we broke $1,200 of annual income. So yeah, I did make a video on that a bit ago that we did break our annual income of $1,200. Now we've reached $1,251 that this portfolio is generating. It currently has if you were to buy this portfolio today, a yield of roughly 2.98. The yield on cost for what we've paid for what it now offers is 3.21. Basically means that within the time frame that we bought all these companies, they've raised the dividend that they pay out by the company, and that overall increases the yield on cost for the shares that we own within the portfolio. And we haven't bought anything lately, so there hasn't been any need to update this. Here, if we look at our holdings, we can see that our value here, $42,003 here, $42,003 rounded up to four. So this is exactly where we're sitting at right now. Annual income of around $1,251. Now, I have been looking at companies that are coming up on ex-dividend. Today, as I'm recording this on the 5th of September, 2022, Tuesday, we have Avery Dennison going ex-dividend. Their trailing 12-month yield is 1.5, pretty low. But they do have a very nice payout ratio of 29.97, 11 years of dividend growth. And on a yearly dividend growth rate, 3-year, 5-year, they raised their dividend almost double digits right there, right? 9.24 to 10.64. So you're looking at about a 9.75 average raise per year. So you do the rule of 72, right? 72 divided by 9 or 10. So within 7 years, you could essentially see your dividend income from this company double by just kind of using the dividend growth calculator-ish. Also, we have Waste Management. I think I hit where I want to see this one at. They don't offer like a very strong yield right now. Let's see, yield is 1.45. Their yield forward is 1.54, just because they're due to raise their dividend probably in the future. DLR, this was beat up here in the short term. So you'll see here that their 4-year average yield is 3.3, but they're currently offering a 4.02 right now. So right now they're trading below. Their yield is higher than on average. That's because their company itself is getting beat up here in the time, and their company is trading price lower, yield higher. Merck is also coming up on ex-dividend on the 14th. So the 14th is not this week, but the following Wednesday is DLR and Merck. So here we have Merck at 315. Average yield is 2.94. Cisco, I wouldn't be buying Cisco at the moment. I've kind of talked about Cisco many times. I'm just not buying it. I'd like to actually remove it out of my portfolio, but I just don't know when I'd like to remove it. It's doing okay. I don't think it'll do better, but I don't want to sell it, right? I don't know if I should sell it, if I don't sell it. Do you guys hold Cisco? If you were holding Cisco, would you sell out of it? Let me know down in the comment section below. Main Street Capital, average is 7.38, but it's offering 6.34. So you can see Main Street's pretty high at the moment versus its average price. Cisco in October 6, 2.35 to 2.39. So this is kind of trading in line. Lows 1.76 to 1.61. So these are the companies that are coming up on ex-dividend, and I put them into my calculator or my charts. So Avery Dennison is coming up on Tuesday. Here we can see big trend trending down. It did hit that 200-day moving average and actually stopped. So here, that orange bar right here at 200-day moving average at 184.86 is acting as support. Now it could bounce and kind of trend on its way, or even kind of follow along its 200-day moving average, or it could break below its 200-day and could continue breaking below its 50-day moving average. If it does, you can see here, it could fall down from the 180s all the way down to the 160s. Pretty easy. There's really not a lot of support time between here and there. But we can see this the 50-day moving average is kind of an uptrend. So we could have potentially, if this bounces to the upside, Avery Dennison, we have a golden cross where the 50-day crosses over the 200-day. That could show some really strong signs of growth momentum. You also want to look at the fundamentals behind it to see, what were their last earnings, how did it come in with their earnings per share and revenue and such like that, if you really want to take a look at that. But technical wise, it could bounce and move higher if it stays and continues moving above that 200-day. Waste Management, this one's coming up on ex-dividend again. This one is on a downtrend right now. It may not stop until it hits 162 before it finds some support on that 50-day moving average. Um, you can see here the 50-day kind of crossed over the 200-day. It didn't actually form that golden cross. That generally happens. We then had a big dip and then 50 cross under that 200-day. Here we had the 50 crossing over the 50 cross over the 200-day. They kind of mark the end of the top. It's kind of interesting how it kind of marks. So let's see here. We had a point right here where it kind of marked the end of the peak, and then we had a cross right here where it kind of marked maybe the end of the bottom, and this could be the mark right here where it kind of marked the end of the peak. So it's kind of interesting on the trends here, but that's waste management. I don't think I'd buy into this one at the moment. I'd kind of just wait for this one to kind of hit 160s. That would be probably where it would show signs of support. Digital Realty Trust, this is that one that, hey, hit a low, hit a lower low, hit a lower low, hit a lower low, and there's really no stopping it at the moment. It could continue trending for quite a while. Yeah, see, look at this. Look at the 1 year, look at the 3 year here. So 118, we're looking at January 2020 timeframe, that March 2020 timeframe where everything just kind of fell off a cliff. That's Digital Realty Trust right now. This one could just continue falling, and there's no end in sight at the moment. So I probably wouldn't want to add capital into that one. Merck, right? They're coming up on next dividend. They have a pretty high yield on average for the time being. Their price has, their price doesn't really have a time where it has like a really hard time keeping and staying above that 50-day. But they are looking like they may hit that 200-day, or they have already kind of hit a stopping point here. We can see some support right here at the $85 mark. So they hit 85, bounced right off of it, hit maybe 87, 88, kind of fell in between there, but they're 86.23. So Merck could be a potential opportunity. So we can kind of watch, put this on a watch list, set a alert of say $84.50 or $85 just to kind of see if it hits it. And just kind of monitor it. If it just kind of begins to do an uptrend, you can kind of see these momentums where, hey, it goes down, it goes up, it goes down, up, and so on. So this could be an opportunity right here for Merck to kind of buy more. Cisco, as we kind of talked about, it is on its downtrend for quite a while here. This could be a buying opportunity, or it could just kind of fall below its 50-day and fall back into the low 40s or even $30. Main Street Capital, broke right through its 50-day, 200-day moving average. That's at $40 right now. It could fall as into the 30s potentially if it doesn't make any signs of recovery. So not one I would look at the moment. Cisco, again, broke right through both 50-day, 200-day moving averages. It could fall down into this range here, and you'd want to look for these little similar graphs. You can see kind of two double bottoms, higher double bottom, two double bottoms, two double bottoms, and then usually there's a spike right after that. So we already had that first one where it kind of fell very sharply, bounced very quickly. Here we're kind of forming the other one. So if you don't mind a little bit of downside risk, Cisco could be the potential one where, hey, you'd buy into it right now, buy into it as it's kind of dipping down, and eventually it'll kind of pop back up, all on its own. And then lows here, downtrending for quite a while. I think they had some in sale. They had some sort of, I remember their earnings. They came out with their earnings and they had like, if the inflation hasn't been working well with them and stuff. I forgot what the news was, but I remember there was some news with inflation and Lowe's and Home Depot kind of being somewhere in the headlines there. But overall, their price has no problem going over the 50-day. You can see some nice strong momentum. Hit that 200-day, bounced right off the 200-day, moved all the way down to that 50-day. It looks like it bounced off its 50-day. It's looking for some support right here. So there is quite a bit of support. You can see that past support here for lows in the 193, 195 range. And then it could potentially hold it and continue trending upwards. I think this is a pretty good buying opportunity for lows. You're not buying at the bottom, but you're buying on a nice uptrend where it's testing the support level of 193 before moving higher. So I would say Lowe's isn't at a bad point. It's a lot better buying now versus back when it was $250, right? You're getting nearly a $60, $70 deal, and you're buying it on an uptrend off its 50-day. If you were a little bit less risky, you kind of wait for this one to make some momentum off that 50-day moving average before you bought into it. But overall, when I take a look at these, I do like Merck. I think Merck is a decent opportunity at the moment, and also Lowe's. I think those would be my 2 points. Like if I were to buy right now, I would probably buy Merck and Lowe's, with the majority probably going towards Lowe's. Yeah, I would say that, right? It's been quite a while since I purchased much. So I'm going to actually do that. Let's go ahead and do Merck. It's been a while since we've done any sort of buys publicly. So we'll go Merck, and we'll go ahead and we'll put 300 into Merck. Let's see, actually we'll do 298. 298.77, confirm that. And then on the flip side, we'll do Lowe's. I think that these are both pretty decent. They're not, Lowe's is still up 45% in the portfolio, so it's not like we're averaging down on these positions. It's just that our positions that are in the negative, there's a reason that they're in the negative, and they're not looking like they're going to be turning around anytime soon. So it's okay to buy positions that aren't in the negative. They're still green in your portfolio, but you're just looking for this opportunity, such as now, right? Where you're not buying it where it's beat the heck up and there's no end in sight. There is a potential end. There is some support along the way. So these companies could turn around and trend back up. But right now we're just kind of capitalizing on investing our capital, continue to grow our dividend portfolio. And these companies are coming up on ex-dividend right here. Merck is coming up on ex-dividend on the 14th. That's next Wednesday. And then Lowe's is coming up on ex-dividend on the 18th of October, which is about a month and some days away. So not too long away. And Merck has 11 years of dividend growth with almost double digits in their dividend growth rate. And Lowe's has 58 years of dividend growth with double digits growth rate, 20 and 18%. And their payout ratio, Lowe's 27.19, Merck 35.45. So both of them are very strong payout ratios, under 40%. So both of these companies are very low risk of cutting dividends during tough times and just continue to raising their dividends very strongly going forward. So that is the bonus, number 5. What companies are we buying this week, right? So that is going to be it for this video, you guys. If you haven't subscribed, definitely go down below, hit the red button to subscribe, make it gray, hit the bell to be notified every time we release a brand new video, and of course, give this video a thumbs up, make it blue, and I will see you guys in the next video. Bye-bye.